So in the original plan, we were doing this in two phases. Phase one of the changes we were going to implement for 2019. So we changed the AFR in Gateway. We added things like the capital asset schedule, beginning balance, additions and reductions in that. There were things that we went over in 2018 and 2019 on that. Those we were going to audit in 2020, and then COVID hit. And it was decided that with all of the stresses that everybody was under, it was just too much. So we went back to the regulatory the way it was before. Now, there were a handful of counties that we had actually started on the phase one, so they were actually audited for those changes. But for everyone else, you went back to the old model that we had before the enhanced regulatory. So we did not implement phase two changes in the AFR for 2020. We're still auditing on that old model. But we are going ahead now, and we're going to implement both. The phase one has stayed in there. We're going to add the phase two changes to the AFR this year. So when you're filling out your annual financial report in January and February of next year for 2021, it's going to include those phase two changes. And when we audit for 2021, it's going to be for the whole phase one and phase two together. So we're not doing it in phases anymore, except for those handful of counties that actually got the phase one audit the first time. Okay. It's not moving. Okay. So prior to phase one, I'm going to do some kind of remembering and adding the new stuff in. But prior to phase one, your financial statements were presented. All your funds were along the left-hand side. Along the top, you had your beginning balance, receipt, disbursement, and ending balance for each fund. And you just had a row for each fund that showed the beginning balance, receipt, and disbursement for that particular fund. It all came to a total at the bottom for all funds. Okay. What we intended to do for phase one was use what were the combining schedules that were a supplemental schedule and use those for the financial statements. So a handful of counties actually, their reports actually showed it this way, but for most of you, we stayed with the original. But that was where we were going to put the classification of receipts and disbursements along the left-hand side, and along the top, we were going to list the individual funds so that you had the detail of receipts and detail of disbursements for each fund, and then a final column that totaled for all funds. So we're not going to use that format unless you were one of the few counties that did have the phase one. What we are going to do is go immediately to phase two for 2022, and that is where we are going to aggregate the funds so that the financial statement itself will have one column for the general fund. I think that's in the next one maybe. One column for the general fund, one column for all your special revenue funds, one column for your capital projects, debt service, any permanent funds that you have, if you do have an enterprise fund, fiduciary funds, and then a final column for other funds. Okay. So general fund will always be shown by itself, but all of your special revenue, so we're talking MVH and assessment and health and all of those other operating funds that we call special revenue funds, those will all be aggregated into one column. Okay. No matter how many debt service funds you have, if you have one or you have 10, there's going to be one column and they're all going to be aggregated into one debt service column. The same for your capital projects. Okay. So what that provides the reader is you've got your general fund separate, what your special revenues are paying for, how much you're paying out each year in debt, how much you're paying out on capital projects. Again, the others are probably not as common if you have permanent funds or enterprise funds, but it will show the transactions for that. Your fiduciary funds are your trust funds. That's where you're holding money that does not belong to the county. So these are your trust funds, like pension, okay? Or your settlement funds, where you're holding property taxes for all of your county, not just what goes to the county. And as a reminder, to get this schedule, we do a macro on the information that's uploaded into Gateway. So nothing is changing on how you upload your financial statement, your financial by fund. That stays the same. That hasn't changed. When you're doing the AFR, that's going to be exactly the way you've been doing it all along. It's just the macro that's going to create the financial statement is going to change, and you're going to have a different format. We talked about it in the spring. You do have the ability in the Gateway outputs to create that financial statement if you want to see what it looks like. Once you have the information in there, you can create it to review it. Okay. So here's an example of how that statement will look. And again, on the left side, you've got that classification of the different types of receipts. So you got your taxes, licenses and permits, intergovernmental, charges for services. And then underneath that, you have a total receipts, and then you're going to have disbursements, so personal services, supplies, other services and charges, debt service, capital outlay, operating expenses, other disbursements, come down to a total disbursements. You're going to have a line, which is the excess or deficit between receipts and disbursements for the year, and then your ending balance for that particular fund or group of funds. So again, general's by itself, all of the special revenue are pulled together, and same all the way down the line. And then you'll have a total column all the way to the far right, which is the total for all funds. Okay. The other funds column, that is unique to regulatory because it is a regulatory report, not a GAAP report. We can modify it to suit our needs for this. That other fund is where your payroll withholding funds are going to go. Under the old GAAP requirements, under GASB, the payroll were agency funds. They were treated much like your fiduciary funds, but under the new GASB, that agency classification does not exist, and they are not considered fiduciary funds because they come from the operations of the county. But they're not money the county can spend because you're withholding it to pay, federal income tax, state income tax, health insurance premiums, things like that. So to simplify the presentation of that, we've put those in that other column. Okay. Right now it is, but there can be. You can have several payroll withholding funds that are going to be in that one column. So if you have a separate fund for each type of withholding, it's still going to be one column. Okay. This did come up during the audits this year, and I want to clarify this because I was not very clear. This is my fault. We discussed classification of receipts and disbursements and how important that is during the audit when you're posting your receipts and disbursements, that you properly classify these. And so we had exercises even this spring on classifying, is it taxes, is it intergovernmental, to go through those. And I said, do not just choose other for everything. It has to be properly classified. But for that other column or the fiduciary column, for the other column, those last two columns on there, those are not revenues or operating for your county. So in that fiduciary fund, those are your trust funds, predominantly, that it's money you're holding, or settlement funds, it's money you're holding after settlement collections would be another one, that you are holding on behalf of someone else. And this is one of the times where you're going to pull other disbursements and other receipts as the appropriate classification. Even in, like, after settlement collections, you're holding property tax. It's not your revenue, okay? You're collecting that revenue. You're going to disperse it to the cities and towns and townships and libraries and schools. It's their revenue, but it's not yours. And so by using that classification of other, it clarifies for the reader that this is not county revenue. This is other. And so I wanted to clarify that because I did not say that at the time. So for those fiduciary funds and for the payroll, when you put those in, those are other receipts and other disbursements. Is that clear, or does that make sense? Okay. Okay. And then there are additional changes that are going to be related to the note disclosures. Remember, the notes are an integral part of the financial statements. They are audited along with the financial statements. We do put an opinion on them. Okay, so they do need to be materially correct. There are additional note disclosures that are required under the new enhanced regulatory, both Phase 1 and Phase 2, that we're going to go over today. Prior to the enhanced regulatory, the notes were pretty standard. They didn't require a lot of input from you to make or to generate those notes. So we could do those with the macro, and they're pretty standard across the counties. But that's not going to be the case with the enhanced regulatory. There's going to be other information you're going to have to put into Gateway in order to generate those notes. Okay? So we want to go over those. So this is just a reminder on long-term debt. You've already been loading this in because this is one of the Phase 1 changes that was in the 2019 AFR. And since it was pushed back, we didn't actually audit it. Again, except for a handful of counties, or the GAP counties. But it got pushed back, but there will be a long-term debt note, okay? It's no longer a supplementary schedule. It is now part of the notes to the financial statements, okay? You have been, in 19 and 20, you loaded in your long-term debt information. So this isn't new for you when you're filling out your AFR in January and February of 2021. But it will be included in your January 2021 reports that we're auditing as a note. The schedule shows the beginning and ending balances, as well as any additions to the debt that is issued during the year and any reductions, which are the actual payments on your principal. There's also a secondary schedule that shows the outstanding debt to maturity. The schedule is based on the amortization schedules that you have uploaded into the debt management portal on Gateway for DLGF. So we have access to that. We worked it out with them to pull that information in, and we run a macro on those amortization schedules and produce the schedule we need for the notes. What it does is show the principal and interest payments for each of the next 5 years separately, and then it aggregates it in 5-year totals until it's mature. There aren't any additional changes to that. I just wanted to remind you of that because it will now be part of the notes again, but you've been filling that information out. Leases. Okay. In the past, get through all of this, on Gateway, we provided guidance to you that we wanted you to report all leases, which are debts, capital and operating. The capital lease is a leasing arrangement where the county receives ownership of the leased asset. So your lease rental bonds to a building corp where you end up owning the building. If you're leasing vehicles and you own the vehicles at the end of the lease term, like sheriff's cars or something, and you own those at the end of the lease term, those are capital leases. In an operating lease, the county has the use of the leased asset, but they don't ever receive ownership of it. So this is really common in copier leases. So you might lease a copier for 3 to 4 years, You pay the lease payment every year or every month. At the end of the lease, they come get the copier and bring you a new copier, and you have a new lease arrangement. You don't ever actually own the copier. You just get to use it during that time. And those were operating leases. Okay. The only asset that you capitalized was the one that you owned. So the building that you got through the lease rental bonds, the cars that you bought on a lease arrangement that you ended up getting title transferred to the county. You capitalized those. That copier that you just bought, you just used for 3 or 4 years under a lease, you didn't capitalize that because you never owned it. Okay. So that's what we were doing. Okay. This is different because on your debt management schedule for DLGF, or debt management portal, they only asked you to put in the capital leases. So you had to make a distinction. We were asking for all your leases. They only asked you for your capital leases. Okay. So along came GASB 87. GASB is the Government Accounting Standards Board. They set the standards for GAAP, for government units. We are trying as much as possible to conform to GAAP. We are not GAAP in a regulatory, but we're trying to get our regulatory as much as possible to comply with that, which is why we're adding the notes on debt, capital assets. The idea, again, hoping to be that if we come closer to the GAAP format, they will not require all of you to produce GAAP financial statements. With GASB 87, there is no longer a distinction made between a capital lease and an operating lease. Leases are just leases. Anything that's over a year in length, you report. Under GASB 87, you capitalize an asset for the use of the leased asset. Okay? We're not going to go into that unless you're GAAP, and if you are, Tammy's out at the desk right there. You can talk to Ricky and I later. Okay? And again, I want to make clear here, when they're talking about it, we're not totally ignore things where you're renting a piece of heavy equipment for a road project for 6 weeks. We're not talking about those. We're talking about things that at least last a year or longer, okay? So what we're going to do for the regulatory reports are, for the leases, formerly known as capital leases, where the county will receive ownership, you will still capitalize that asset. So if you're having a building done through a building corp and you're paying lease rental bonds, you're going to capitalize that building. If you buy sheriff's vehicles on a 5-year lease and you get title to those sheriff vehicles, you're going to capitalize those vehicles. Okay. If you are leasing a copier but you never get ownership of the copier, you are not going to capitalize that, just as you've always done in the past. You will still report both types of leases as debt obligations. The note will disclose the name of the leaseor, the purpose of the lease, the annual lease payment, and the beginning and ending date of the lease agreement. So you'll have to put that information into Gateway. For the capital leases, there will be a debt to maturity schedule based on the amortization schedule that you're loading into the debt management portal in Gateway for DLGF. And this schedule will look a lot like the debt schedule. It's going to have, again, each year for 5 years, and then an aggregate amount if the lease is that, like a lease rental bond where it goes more than that. It'll have it in 5-year increments up to the maturity. There will not be any debt to maturity schedules for the what used to be called operating leases, because we don't have any data on that. Okay. What we are trying to do is have a column added to the schedule where you can just say, is this an asset the county will own, yes or no? And if it says yes, we'll pull that information from DLGF's debt management. If it says no, we'll just leave that part out. It is October. In the event that IBRC cannot add that, I don't know how hard it is to add that functionality. We have asked for it. If it cannot be added, then the guidance is going to change and you're just not going to have to put your operating leases in because we don't have information in the debt management for the operating leases. Okay. So hopefully there'll be a column where you can say yes or no. If there's not, the guidance at the top will say just put in leases for the assets that you will take ownership of. Is that sort of clear? You don't lose anybody? Okay. If you think about it and it doesn't make sense, call me. You know, you can call Ricky and I during January and February, and we'll be glad to talk you through this. Okay, for 2019 and 2020 on the annual financial report, you did have to complete a transfer schedule to show the money transferred from one fund to another. That transfer schedule will become a note to the financial statements for 2021. So we'll pull that in there and we will be auditing it. There's no change in the AFR. You've already been loading that information in, so you will continue to do that. However, there's an additional schedule that's being added for 2021, and that is for interfund loans that have not been repaid as of the end of the year. Okay, so for example, let's say there was an interfund loan between MVH and General Fund where MVH loaned the General Fund $75,000 that was expected to be repaid with false settlement. However, due to unforeseen circumstances, that loan could not be repaid. An ordinance was passed and the council determined an emergency existed and the loan repayment was moved back 6 months. This must now be disclosed in the interfund activity note. There will be a schedule that's completed that still shows the $75,000 is due. From our example, it would be $75,000 due from General Fund due to MVH. There should be an explanation of why it was not repaid. Again, you just say there was whatever the emergency was and that it was extended 6 months because of that. Okay. And this is what the schedule looks like. It's very similar to the interfund schedule that you have been filling out. Instead of saying transfer from and to, it just says due from and due to, because this is amounts that will be repaid. Okay. If you don't have any unpaid interfund loans, you're not going to fill out the schedule. It's only if you have interfund loans that have not been repaid at the end of the year. Okay. Significant contingent liabilities. This note was planned to be part of the phase 1. It should have been presented for 2019 and 2020, but again, it was delayed, so this is just a reminder. A contingent liability is a liability or a potential loss that may occur in the future depending on the outcome of a specific event. Pending lawsuits is one of the most common examples of a contingent liability. So basically, some transaction is in the works, such as a lawsuit. Contingent on the result of that event, the county may have to pay out money, which is a liability, or lose property, which is an impairment of an asset. And there has to be at least a reasonable possibility that it will occur. So if a sovereign citizen is suing you for $20 million over a violation of their sovereign rights, you would not have to disclose that. Okay? It has to be reasonable. So an example of what a contingent liability note might say is a jury awarded $50,000 to a former employee of the county for alleged wrongful termination of employment. The county has appealed the judgment on the basis of error in the judge's instructions to the jury and insufficient evidence to support the amount of the jury's awards. The final resolution of this matter is not expected to have a material effect on the county's financial position. That's the note. You're just disclosing what's out there and whether or not you think it's very probable or possible that anything is going to change it and how material it is. In this case, it's $50,000, so it's probably not real material to you. Okay. A significant commitment. This discloses a current commitment or contract for a future purchase after the report period. So this could be if you're buying salt or gravel and you've done the contract or the commitment for it in the current year, but you're not going to be paying for it until the future year or signing the contract. Or you could be entering into a contract for a capital project, but you haven't actually paid any money out yet or anything. You've just entered into the contract. So an example of this might be the county has entered into a contract with XYZ company to complete extensive renovation of the jail. The contract is for $2.5 million. You're just disclosing the fact you're going into that next year. Okay. The third one is a subsequent event. This has always been a note to the financial statements. This is one of the few that you would have had to put the information in and for the note to generate. I only included it here to show you how it's kind of different from the others, although they all seem very similar. This is an event that has occurred after the end of the reporting period, so after December 31st, but before the financial statements are issued. The most common example is the issuance of debt. So in a contingent liability, something big may happen, but it hasn't happened yet. And it's still contingent on something changing. In a significant commitment, the contract occurred, but no money has changed hands. In a subsequent event, the event is occurred between the end of the calendar year, the reporting year, and when the financial statements are issued. So the transaction has already occurred. So the bonds were issued. You've received the proceeds. Okay? So a typical subsequent event note by the county issued general obligation bonds of $5 million in February 2021 or 2022 to complete work on the renovation of the jail. The bonds mature in 30 years. Okay, that's a subsequent event note. Fun one, capital assets and depreciation. I can hear the groans. Prior to enhanced regulatory, you just did a capital asset schedule as a supplementary schedule, which just showed the ending balance in each category. So you had land, X amount, buildings, X amount, infrastructure, X amount going down through. The schedule was not audited. It was just supplemental to provide information to the reader. Starting with 2019, AFR that you completed in Gateway, you had to provide the additional information on your capital assets for the beginning balance, the additions and the reductions, as well as the ending balance. Okay. So that schedule was put in the AFR, and you've been completing that for 2 years. That information was to have been moved into the notes of the financial statements in 2020. It wasn't done, that got delayed, but it will be for 2021. Okay. You'll continue to fill it out the same as you have for 19 and 20. You're just going to update it for the new year. However, there will be a new schedule in the AFR for 2021 that you will have to complete on the accumulated depreciation for all of the categories except land and construction in progress. We did train on this in 2019, 2020, and 2021. The training is still available on the SBOA website. The accumulated depreciation schedule will be included in the notes of the financial statement. Underneath the capital asset schedule, there will be an opinion on it, so it's important that we get that as correct as possible. If you still have questions about it or issues with it, now would be a good time to get a hold of us to get through it, because this is going to be in the January and February when you're working on that AFR. Conduit debt obligations. Conduit debt is a debt that the county issues under their bond rating, but the county is really not responsible to repay from county resources. So the proceeds of the debt is provided to a third party under a separate written agreement, and that third party is going to repay the debt. So these are like economic development bonds, our common conduit debt arrangements. So a typical note is just going to disclose from time to time the unit has issued industrial revenue bonds or economic development bonds to provide financial assistance to private sector entities for the acquisition and construction of commercial facilities deemed to be in the public interest. The bonds are secured by the property financed, are payable solely from payments received on the underlying mortgage loans Upon repayment of the bonds, ownership of the acquired facility transfers to the private sector entity served by the bond. Neither the county, the state, nor any political subdivision thereof is obligated in any manner for repayment of the bonds. Accordingly, those bonds are not reported as liabilities in the accompanying financial statements. They're not part of your debt schedule because they're not truly your debt. You facilitated and they used your bond rating to get that debt, but another entity is responsible for paying that back. And you do have to disclose all of that conduit debt, even though you're not responsible for it, you still have to disclose that it exists. So we talked earlier about the long-term debt note for bonds, and we also talked about it for leases. Short-term debt also needs to be disclosed, and this is debt that is paid off within a year. So things like your tax anticipation warrants and lines of credit, so short-term. So those do need to be disclosed. You have to show your beginning and ending balances, any additions and reductions, and a description of the purpose, why you took out the short-term loan. This is an example of the schedule. So in the AFR, you'll have a schedule to complete, and the macro will create this schedule. So it looks something like this. So this is showing the first line, the tax anticipation warrants, and then the line of credit. For both, there was no beginning balance. There was no short-term debt that existed at the beginning of the reporting period. It shows what was issued, what was repaid. So the tax anticipation warrants were completely repaid during the year. The line of credit was taken out, but there was $35 million that was not repaid by the end of the year, so it still has to be disclosed that it is still outstanding. But it's possible that your ending balance would still be zero. You still have to disclose the activity for the year. Okay. Tax abatements. Oh boy. Okay. We heard about those earlier today. So we know what tax abatements are, I hope. So it's an agreement between one or more governments and an individual or an entity in which the government promises to forgo tax revenues to which they would otherwise be entitled, and the individual entity promises to take specific action after the agreement, that's an important phrase, after the agreement has been entered into, that contributes to economic development or otherwise benefits the government or citizens of those governments. And there are disclosure requirements for tax abatements. If any of you had schools come to you, well, they had to report it already this year, so you may be aware of this. So the county, along with other taxing districts within the county, you have your maximum tax levy you can impose. You do your budget, supported by other revenues. So you come up with your tax levy, distribute that. It was better explained by Tara yesterday, but you distribute that over your net assessed value on your political subdivision. When abatement is allowed, that reduces the assessed value of certain property, and again, in return for some benefit to the unit that gave the abatement or to the citizens of that unit. But in effect, as Barry talked about today, that shifts a portion of the tax burden onto the remaining citizens. And GASB 77 decided that that had to be disclosed to your citizens. You've made that decision on their behalf. They need to know about it. Yes? Oh, we're talking about all of them. We'll get into that. We're talking about all of them, yeah. So what GASB 77 says is that tax abatement agreements are often used by a government to encourage new development, redevelopment of blighted areas, and job creation. In Indiana, it's the redevelopment of blighted areas. These agreements result in a foregone revenue for a period of time. The disclosure requirements of GASB 77 will allow financial statement users to access information pertaining to tax abatements and incentives and to gain an understanding of the impact of those agreements have on a government's revenue. Okay, so for enhanced regulatory, we are going to be reporting tax abatements, not to the level that you will have to for GAAP, but it kind of follows it. You do have to disclose the tax abatements that your county has awarded in one section, and then you have to disclose any other tax abatements that another unit has approved that affects your tax revenues. So if a city or town within your county has approved an abatement that reduces your tax revenue as a county, you have to disclose those as well. Okay? Okay. So only counties, cities, and towns in Indiana can enter into tax abatements. So those are the units we're talking about. As Barry discussed today, that's in 6-1.1-12.1. Provides a deduction of the gross assessed value of property in return for some benefit to the unit, economic development, some housing development. I'm not going over that because he talked about it today. DLGF does have memos on it and presentations on it, and they do that much better than I would be able to explain the whole process of getting an abatement approved. But again, however, you do have to report those abatements. So you're going to have to, under GASB 77, you're going to have to disclose tax abatement agreements, dollar amounts by which the tax revenue is reduced, any receivable amounts, and policies pertaining to significant tax abatement agreements. But I think the enhanced regulatory note that I've seen does not have those policies. It just talks, it's just the basic facts. The abatement, how much is the dollar amount of revenue that was foregone, and any receivable amounts. Okay, so it comes in two sections. So the first section is the abatements that are authorized by the counties. These are your own abatements that your county has approved. In a GAAP note, there's a lot more specific information that's required, but it's pretty similar. They're pretty similar in the regulatory note. So it's going to disclose the name or the purpose. So you can put all of your, basically all of your economic revenue ones together, or redevelopment, which is most of them. I don't know how many housing we do. But if all of them are for economic redevelopment, because it's in an economic redevelopment area, you can just aggregate them in one line. You don't have to list them separately. The total amount that is abated for the year. So really, it's basically, the assessed value that was the reduction in the assessed value, and how much that reduced your tax rate. So your tax levy was reduced by that. So do that calculation. For this first year, you need to look at all of your existing abatements because you have to disclose that for the entire time that the abatement is in effect. So if you have an abatement that's in its 8th year, you still have to disclose that, even if it only has 2 more years. If it's in the 10th year, you're going to have to disclose it even if it's the last year. And then any new ones that have been approved, you're going to have to disclose those for that year. For the indirect, the ones that the county hasn't approved, but a city or town within your county has, if they're affecting your tax levy, then you just do those by the unit that approved them. So the city or town, if they have more than one, you just aggregate them together. Okay. And again, it's anyone that is in effect for the report period, for the year that you're looking at or reporting on. So this is an example of what the note disclosure is going to look like, pretty much what your schedule is going to look like in the AFR. You put in the type, and again, most of ours are going to be economic redevelopment or revitalization because that's really what the basis of the law is. The specific type that's being abated, whether it's real property or personal property, which is really our only choices. I did do some research. There are some reductions of tax that the state does for income tax, but fortunately for us, everyone I looked at, the reduction or the credit comes after the fact, so none of them have to be reported. Thank you so much. I don't have to mess with that. So you really are only looking at the personal and real property ones. Okay. And that's why I said that phrase, the agreement has to come first. So there are some, you can get a reduction on your income tax if you do certain things in a revitalization area. But you put that on your tax statement, just like you do any other deduction. It's after the fact. It's not an agreement you enter into before, and that's why it does not have to be disclosed. The next column discloses the amount of the tax revenue foregone by the county due to the abatements for the reporting period, so for the year just ended. Okay. So this is not the amount of the reduction of the gross assessed value. You're just going to take that reduction of the gross assessed value times whatever your tax rate is, basically. And that should materially give you the amount for the note. That's what you've forgone for that year. Okay. The last column is to disclose any receivable that the county will receive as a result of the abatement. So this would be like your abatement fee. If you're going to get a fee back, like up to the 15% for economic development, that's a receivable. So you do need to note we're going to get, in Barry's example, $2,000 back from this, or total them up. If there is no fee, then there's no receivable that's going to be coming back in, and you would put that as 0. In the second part of the schedule, you're going to do the same thing, except you're going to aggregate it by who passed it. So the town of so-and-so has 3 abatements, then you put, aggregate those together and put the same information. It's either real property or personal property, and the total amount of revenue the county is forgoing, not what the city or town is. It's you're only looking at telling your citizens what the county's revenue loss is due to this abatement. Okay. And again, if there's a receivable due to you from that abatement, even if it's from another unit, if you're going to get money back, then you would show that as receivable. If you're not getting any portion of that fee back, then you would leave that at 0. So, any questions on that? I know that's a lot.
Wait, right here.
Okay, Lori, just to be clear, I'm kind of thinking this out loud. So the abatement information that's reported, the amount of the revenues reduced as a result of the tax abatement, that would have been for the year that we're reporting. So let's say we're working on our 2021 statements. That would have been for the year 2021. But the receivable, the amount that we're going to get in the imposed abatement fee, that will be the amount that we're getting in 2022. Correct? And we won't really know that amount until we calculate the next year's tax rates. But
for the enhanced regulatory, it is probably the receivable that you were due for 2021. For GAAP, it's going to be different, because you're really telling them this is what we lost and this is what we got in return. But for GAAP, yes,
okay.
You're right. But you should know, if you know what it is, 15% of whatever,
right.
5% of it, yeah.
okay.
Yeah,
Thank you.
it's a different term on the receivable, but yes.
I received a phone call from one of the schools wanting to know all this information on tax abatements. And I wasn't sure what information to give them, so they've waited until I could give them more information. But they are in the city of Auburn's limits, or they're going to get really more information from the city of Auburn's tax abatements. And although we have all that information as far as all of the abatements for the county, we don't know their fees that they charged and all of that. So what kind of information can we give to the schools?
You know, they're going to come to you first just to figure out if there is an abatement. So the auditor should know if there is an abatement because you're in the
Right.
taxes. If they need additional information on that, like a receivable, they will need to go. They are not going to get the receivable, period. So they're going to have nothing to report on that because they don't do economic development. So no money is going to be coming back to them. But if they need more information, you can say, this is Albany's abatement. You might need to go to them to get additional information for that. But they're basically going to do the same thing. What was the amount of the assessed value that we lost, you know, and their tax rate, and they can kind of figure out what their foregone revenue was for their school district. But it's not your job to calculate their loss. You just need to let them know there was an abatement, what the terms were.
Oh, so we don't have to do their calculation for
No,
them?
that is not your responsibility.
So do we give them any information other than, I mean, what information are we giving them?
That the abatement exists, probably, and the assessed value, that is the reduction of the assessed value.
Okay. Okay, thank you.
We currently list ours in separate real property spreadsheets and separate personal property, all the abatements. Do we have to combine those?
No, whatever's easier for you.
That's okay to do that? And then also, do all the schools have to report these? Because we never received a request.
If they said no abatements affect us, they would never have asked you for it, but when they're audited, that could be an issue.
Okay.
But it's not your responsibility to give them the information. They need to come to you to ask for it. So if they didn't ask for it,
Well, and we currently do calculate the loss to the county, the loss to the designating body, and also to the TIF. So,
there's nothing wrong with reaching out to them with that information, but you don't have an obligation. It's their obligation to compile their financial statements and to request the information. But, you know, if you have the information and you want to share it with them, there's nothing wrong with that.
and do we have to report the loss on county TIF?
No, this is just abatements.
Abatements that affect county TIF properties?
Yes.
Okay. Cool.
You? Oh. Not that you can't have a question, just. Okay, how does the abatement affect a TIF district?
I have no idea. I'd have to think about that. Hamilton County probably knows.
Okay.
I mean, it's a reduction in assessed value, so I'm sure it does reduce the amount that the TIF receives.
Yep, based on their capture, is that what I heard?
Yeah.
Okay. Okay, the other one says, we might need a clarification on the definition of revenues reduced as a result of abatements. The abatement of taxes to one entity might result in the other taxpayers paying more taxes than they would have paid, so there would be a net reduction if the circumstance occurs. Is the amount to be reported strictly to involve just the abated entity regardless of impact on the amount paid by other taxpayers?
Yes.
That was the easiest answer there. You didn't follow that?
Okay, off of abatements, thank goodness. Okay. Oh, no, we're not off. These are just a couple more slides on the note disclosure. Again, it just talks about what's in those schedules, and we've already talked about that. So, Okay, landfill, closure and post-closure care. This doesn't pertain to you if you don't have a landfill, but if you do have to disclose this. Indiana Code 13-22-9 is the statute for the financial responsibility for solid waste landfills and transfer stations. If your county has a landfill, you already know that. And if your county doesn't have a landfill, you probably don't care. You are required, if you do have a landfill, to disclose information on the cost for closure and post-closure care. You must disclose the cost to provide the protection of the environment that occur near or after the date that a solid waste landfill stops accepting waste and during the post-closure period. Costs will include the cost of equipment and facilities, as well as the cost of services to monitor the post-closure period. If you're still during that post-closure period that you're responsible by statute for it, yes, you're still reporting it. Okay. So a typical statement or a typical note is going to state and federal laws and regulations require that the county, whatever the name of your landfill, place a final cover on its landfill sites and perform certain maintenance and monitoring functions at the landfill sites for a minimum of 30 years after closure, in addition to operating expenses related to current activities of the landfill sites. An expense provision and related liability are being recognized based on the future cost, future closure and post-closure care costs that will be incurred near or after the date the landfills are no longer accepting waste. The recognition of these landfill closure and post-closure costs is based on the amount of the landfill's capacity during the year. The estimated liability for landfill closure and post-closure care cost is $26 million something as of December 31st, which is based on the 54% usage or as of the date of the financial report. It's estimated that an additional $23 million will be recognized as closure and post-closure care as expenses between the date of the balance sheet and the date that landfills are completely expected to be filled to capacity, which is the year 2025. The estimated total current cost of landfill closure and post-closure care is based on the amount that would be paid if all equipment, facilities, and services required to close, monitor, and maintain the landfills were acquired as of December 13th, 2021. Might be higher due to inflation. Okay, and then you disclose what your financial rate, where your liability is. Do you have a trust fund for it? Do you have insurance for it? How are you funding this liability? Also has to be disclosed. Okay. For related party transactions, this is similar in concept. Not the same thing, but similar in concept to kind of a conflict of interest. Although this has a statutory, that has a statutory definition. This is an accounting term, so bear in mind they're two different things. But what you are reporting are any transactions where the county is not a disinterested party, and there might be more to the transaction than self-interest for the county. The disclosure should include the nature of the relationship and the dollar amount of any receivable or payable. An example might be the county hospital is considered a related party. The county has the ability to appoint and remove a majority of the hospital's board members. The county provided a direct financial subsidy to the hospital from a tax levy. In 2021, the county lent money to the hospital to fund the construction of a new treatment space, give details of the loan amount. The hospital financial statements of the hospital are not incorporated into the county's financial statements, but here's where you can see the hospital's financial statements. That is a related party. You gave the hospital a loan, but it wasn't, you're not a disinterested party in what happens to that hospital, and that's why it needs to be disclosed. Okay.
Hey, I have a question. Over here. Hey, can you repeat the IC code that you gave on the landfill closures?
13, 22, 9.
Thank you.
You're welcome. Okay. Joint venture. This is, again, where you join with another unit you form some interlocal agreement, which is like a contractual arrangement, to operate as a third, kind of a third entity to do a specific activity. You're kind of pooling your resources. So it's hard for me to think of examples. I know you guys do this all the time, but say a county and a township join to build and operate a park for both the county and the township citizens, and they share the cost, and they, appoint a joint board between the two, and they, the county may have the financial arrangements, but that's a joint venture. So the county's paying part of it, the township's paying part of it, so it does need to be disclosed. It's a joint venture between the two. Okay. So the note, again, you're just disclosing the relationship. So you might have something like Perfect County and Pretty Township have entered into an interlocal agreement to establish the Pretty Perfect Park Board to govern and oversee Pretty Perfect Park. The county provides the accounting for the park funds, and both county and township contribute to the operations of the park, which has an annual budget of $80,000. The park also charges fees for the use of certain facilities in the park. The financial statements of the Perfect County and Pretty Township can be accessed through the State Board of Accounts website. You've disclosed it, you've given some general information on it.
Is there a materiality cutoff? Or these are de minimis situations that don't need to be reported?
You can use your judgment on that, but you'll need to be able to defend it. I mean, if you're going all of the work to do a joint venture,
Same thing on related party disclosures, materiality standards.
Now, related party, there probably is. If it's a small amount, you're not going to disclose that. Yeah. I thought you were talking about joint ventures. Okay. Supplemental schedules. Okay. Supplemental schedules are not audited. They do provide valuable information to the reader of the financial statements. Used to be your supplemental schedules were your capital asset and your debt. Those have been moved into the notes. Okay. With the enhanced regulatory report, there is going to be a supplemental schedule, and it is a combining schedule. Okay, so remember the financial statement had one fund for general, one column for special revenue, one column for debt. In the supplemental schedules, you're going to have a combining schedule, not for general, but for special revenue. It's going to list all your special revenue funds. It's going to come back to the total that's on the special revenue fund column on your financial statement. Same thing for your debt. So it's going to break it out into the individual funds. I'm running out of time here. Okay. So again, each of the fund types will have a separate combining schedule that's going to support the column on the financial statement. So this is an example of one for special revenue. So here you're seeing motor vehicle highway, local road and street, plat fund, each individual fund with the details for that fund. That total column in the last column, the total special revenue funds, if you look at one of the first slides, those numbers will tie to the special revenue column on the financial statement. And so it tells you what that breakdown is of those funds. There will also be a separate schedule for debt, capital projects, et cetera. So it just gives additional information on what makes up those columns. Okay. Okay. We did make some changes to AFR. Not all of them complete, so I can't show you all of the schedules. Again, the unit questions are in here. I don't know how hard they are to read on there, but we added questions. If you answer yes, then you're going to get a schedule. So if the question says, did you have any significant contingent liabilities? If you answer yes, you're going to have to fill in information. If you didn't answer no, it's not going to come up. Okay, so it's the same as before. So go through the questions and answer yes or no to each one of those as they pertain to your county for the year. Okay. Please don't answer no just to avoid it. We are auditing these. We will know if you did that. So don't do that. If you're not sure about it and you want to say yes to see what the schedule looks like, that's fine. And if you go to it and you go, oh no, I didn't have that, go back to the unit questions and change it to no, it'll take the way. There's no way to get rid of the schedule other than go back to the original unit questions and answer no. Okay, so if you call us, we can't make it go away. We can only tell you go back and take the units question to the no. And again, still, if you have any questions when you're doing the AFR, give Rick and I a call. We do have access to get into Gateway and look at what you're working on so we can try and help you with it and get you there. We can't do the technical question as well, but if it's actually content, we can help you with that. Okay. There is an additional question that asks you what your capital asset threshold amount is, so you just have to put that in. They are adding questions which are just informational for us, whether or not you have a holding corporation or building corporation that you've established, a redevelopment authority, or a land bank. The reason we ask these is because we have to audit these. These are separate legal entities that must be audited, and so we don't know they exist if you don't tell us. So again, you're not going to have to fill any information on these, you're just going to let us know that they exist. If you have any questions, be sure to call us or email us or whatever you need to do to get a hold of us.